Hello and welcome. You're watching Business Today Television. I'm Sakshi Batra and this is the earnings special edition of Market Today, and our focus is on the tire maker Ceat for this edition. The company has reported a 22.7% year-on-year dip in the net profit at 102.3 crores for the fourth quarter, although revenues from operations have increased by 4% odd at 2991 odd crore rupees. Also at the operating level, we've seen that the EBITDA has improved by 6.5% at 391.7 crores for the fourth quarter, and the margins have stood at 13.1% versus 12.8% in the corresponding period in the previous fiscal. We are now joined by the top management of the company. Mr. Kumar Subbiah joins in. He's the CFO of Ceat. Warm welcome to you, sir, to Business Today Television, and thank you so much for taking the time out for this discussion. First up, if you could highlight what really put pressure on the bottom line, if you could tell us the key reason behind the dip this time.
Now, the quarter four, if you really look at a gross margin, it has actually expanded quarter on quarter. We had one-off kind of or an exceptional kind of some cost that we had recognized in quarter four, which is largely a provision towards extended producers responsibility obligation, where we have taken up with the government parallelly along with the industry body to make few changes and also to see whether effective date can be prospective. So we had to absorb that cost as a normal expenditure in our quarter four results. In addition to that, we also absorbed about 35-36 crores as an exceptional item for the same reason relating to the previous year. So these two would have contributed in terms of lower profits at an overall level. But however, gross margin remained healthy. If you adjust for that, EBITDA margin looks very comparable to the previous quarters.
Okay. So now talk to us about the demand that you actually saw on both the OEM side as well as on the replacement market. How did it fare in this quarter and what's the outlook for these two?
In the quarter that went by, that is the quarter four, international business saw good growth, good strong double-digit growth for us, repeat of what happened in the previous quarter. And replacement part of the business grew in mid-single digits. We would have been in line with the market as far as the growth was concerned. On the original equipment manufacturers part of the business, it was marginally negative. Okay, and so therefore that's the way it stacks up as far as quarter four is concerned. Going into current quarter, I think we see some momentum in the replacement as well as in the international business. And in the case of OEMs, we had to, lose out some volumes relating to large OEMs, which is coming back in some other form starting on quarter one. So we expect that to get neutralized or grow in the OEM segment as we come into the current financial year.
Okay. And what's your outlook, sir, on the export front? The global environment, is it still looking subdued?
Yeah, global, particularly in Europe, it is looking, it is yet to fully recover. Okay, so from that point of view, which is an important portion of our international business, almost 30% of our exports is to Europe. So we are seeing recovery, but it has not gone back to where it was prior to, the geographical issue that happened around Europe. So, but other parts of the world are slowly recovering. As far as we are concerned, we are also getting into some new markets by launching new categories of tires in the next quarter. So, therefore, we look forward to a good year as far as international business is concerned.
So, for FY25 as a whole, if you could share with us what kind of an outlook do you foresee both on the domestic as well as on the overseas business growth, so vis-a-vis FY24?
No, we are seeing some momentum in the local market. So, therefore, if you really look at last year, okay, our growth was largely, we grew by about close to about 5 odd %. All of it came through volume growth. Okay, and price was marginally negative. Going into the FY25, considering some upward movement in the commodity prices, we expect growth to come in the combination of both price growth as well as volume growth. Okay, so we expect to grow more in the international business. As far as Ceat is concerned, maybe we would get to a growth in the OEM business. estimate it looks like going into the current quarter, it would be a higher single digit as far as replacement market is concerned, strong double digits in international. OEM, I think we'd like to wait and watch. Okay, it will move into a positive territory. How much, I think, maybe we need a little more time to understand that.
Right. So you briefly did mention on the raw material prices. Do tell us how did it pan out in Q4 and what is the expectation on the raw material front? Is it going to be a considerable monitorable on the margin front for you over the next 1 or 2 quarters?
Now, after a stable within a zone period of April to September, April to November in commodity overall global commodity prices, and also relevant commodities that go into tires. December onwards, we started seeing some upward movement in natural rubber, and crude has been a little volatile for the last 2-3 months. It's been moving closer to $90, except in the last few days or so. So both of them we expected to have an adverse impact to the extent of little over 4% in quarter 1 versus quarter 4. So that's the outlook that we have for commodities. We hope crude will get back to a level of $80 to $85 range instead of $85 to $90 range, which has just come. And we also look forward to some correction in natural rubber prices, but only time will tell whether it happens or not. So in general, there is a tendency to pass on the incidence of
Yes.
any increase in input costs over a 3 months to 6 months kind of a lag. That's what we look forward to.
So can we expect some pricing uptick from you in this new fiscal year, sir, over the next 2 to 3 quarters?
We have already done that. We have already taken some action beginning of May. We have taken prices of our most of the categories of tires effective early May.
Okay.
And and depending on how commodity prices move, we also have some regulatory related expenses that has come into effect. Okay, and while our endeavor is to push the effective date to prospectively through liaising with the government, that also has an impact on the cost. So there is certainly an inflationary pressure, and it has to get passed on in the form of appropriate prices.
Okay. So on the margin front, what is the outlook on the band that you're looking at for FY25? And what else could be a lever for you to really get more margins than 13.5% right now? How does it go from here?
See, overall, for last year, even after considering reasonable amount of cost provision that we have made for EPR, we are close to about 14% of margin for the year FY24. Okay, so from that standpoint, I think we are in that band, comfortable. I wouldn't say comfortable, but a band within which we would like to operate. Needless to mention, expansion of margin helps in terms of investing in the market as well as on the product. So the recent cost pressure with respect to raw materials may have some short-term impact on the margins. So in terms of levers, we look forward to moving up in value chain, premiumizing our products. Okay, and even international business, if you are able to grow faster than the overall company average and increasing the share of it, is margin accretive. And in general, I think higher inch tires, okay, more premium tires, etc., should help us in terms of improving our margin, in addition to getting some cost efficiency. So these are the levers that we are currently using, would like to use to improve our margin profile.
Okay, sir. So also a little bit on the debt on the books, could you clarify what is the current state and how do we look forward from here? What is going to be the strategy on that front?
No, I think it's a good story. We have had a good year where we were able to generate reasonable amount of free cash flow, okay, maybe after a long gap. And despite managing about 870 crores of capex, we still managed to deliver surplus operating cash flow and free cash flow. That led to debt coming down by about 430 crores in the last year. Okay, so therefore we ended the year at close at about 1,590 crores level of debt against 2,030 crores of debt on a standalone basis. I'm talking about gross debt. So this has helped in terms of improving the quality of balance sheet. Our debt EBITDA is now for the first time in the last 10-20 years that our debt EBITDA is below 1. Okay, our debt equity has strengthened to 0.4. So we are happy with the current leverage situation as far as the organization is concerned. We are happy with the quality of balance sheet. And going into next year, our intention is to spend little more capex than what we had spent last year to complete some of the ongoing project related activities. Okay, so operating margins helped in terms of generating cash. And last year, we look forward to maintaining debt in this range, 1,600 to 2,000 crores, like kind of a level, so that we are adequately investing in our growth on capacities and at the same time not over leveraging. That is the broad band within which we would like to operate as far as the coming year is concerned.
Okay. Any fundraise plans, sir, for the higher capex that you're planning, or this will be through the cash flows that you're generating?
No, the last few years we have been largely managing all our capex through internal accruals. Okay, and if need be so, we will raise some amount of debt if required. As of now, we are managing it through internal accruals, but within this band, 16 to 200 to 2,000 crores, either a short term, long term, depending on how we see the following quarters. So there won't be any large fundraising plan. There will be a small amount of debt if we think that we cannot fund it through all of them through internal accruals.
Okay. Well, all the very best to you, sir, for the upcoming quarters. Thanks a lot for spending the time to explain to us what went through in this quarterly earnings and what is the outlook going forward. Looking forward to more interactions as we meet next after the next quarterly earnings. So thank you so much.
Thank you for having me. Thanks a lot.
All right, and with that, we wrap up this very special conversation with Ceat viewers, and we will continue to get you more earnings conversations from the top managements of the firms that are reporting their Q4 numbers. So stay tuned on to Business Today. On the assets under management as well, again, you have seen a very strong growth. About 9,600 odd crore rupees is where you are at currently. Your estimate, I believe, for FY25 was somewhere to the tune of 12,500 odd crore rupees. Is that doable? Are you looking to revise it upwards?
First question, is that doable? Definitely. We don't see any challenge, reaching a 30% or not of 30% kind of a growth. Very clearly, like I said, demand is there. We have the execution ability to go out there and satisfy the demand of these customers. So we don't see any issue from a demand or an execution perspective. See, at this point of time, we are not looking at revising our growth guidance upward because of primarily, the entire macroeconomic environment and the regulator wanting NBFCs and banks, not just us, but across the large NBFCs, the banks, and every company out there in the financial services domain, the regulator has been cautioning them to be a little more moderate in their growth. So at this point of time, we will continue to keep our guidance of 30%